No empire in history has ever collapsed solely because of a lost war. They collapse because of a lost currency. It is a cold mathematical law that ignored the hubris of Rome, outlived the gold of the Medici, and is now knocking on the door of the 21st century. Imagine a ledger where the numbers no longer represent wealth, but a countdown. By the end of 2025, the United States national debt is projected to hit a staggering $37 trillion. But $37 trillion is just a figure on a screen until you realize the gravity of the interest trap. In 2025, the cost of simply paying the interest on this debt is estimated to surpass the entire combined budgets of the Department of Defense and Medicare. We have officially entered the terminal phase of debt for interest, where the world's superpower borrows money just to pay back the interest on the money it already borrowed. The cracks are no longer invisible, and as the first domino begins to tilt, the only question that matters is who will be crushed when the system finally stops breathing. Imagine the year 1945. The smoke of World War II was clearing, and the United States sat atop a mountain of debt that touched 106% of its GDP. But that debt was a monument to a clear, definitive victory, a massive down payment on a new world order. Fast forward to the present, and the monument has become a tomb. For the first time since that global conflagration, the US national debt is projected to hit at least 100% of GDP during what the history books call peacetime. We are no longer borrowing to save the world, we are borrowing because we forgot how to stop. By the end of 2025, that figure is expected to reach an unprecedented $37 trillion. If you were to look at this on a medical chart, the patient is not just suffering from a fever. The vital organs are beginning to fail. This is the surgical reality of a fiscal path that has officially crossed the point of no return. The Congressional Budget Office has mapped out our descent into the event horizon. By 2028, we hit a mathematical tipping point, where interest costs alone will consume more than 60% of the entire federal deficit. Think about the absurdity of that statement. We are approaching a moment where the vast majority of every new dollar the government borrows is immediately vaporized just to pay the interest on the debt that already exists. It is a lethal feedback loop where fiscal policy becomes a ghost. You cannot build infrastructure, you cannot fund innovation, and you cannot protect the vulnerable when you are trapped in a basement, frantically writing checks to cover the cost of the basement itself. To see the true depth of the rot, we must peel back the layers of the $31.4 trillion headline. On the surface, the government likes to point out that it owes a large portion of this money to itself. But once you strip away the internal accounting tricks, you are left with the cold, hard bone. $20 trillion in debt held by the real public. This is the refinancing risk debt. This is the debt that lives in the real world, and it is currently being slammed by a relentless rise in interest rates. It is a trap that resets every time a treasury bond expires, and the jaws are getting tighter with every passing month. The numbers are screaming, but if the patient is this terminal, why is the heart not stopped beating yet? The system continues to breathe not because it is healthy, but because it has effectively taken the entire global economy as its bodyguard. Imagine a poker table where one player is down $37 trillion, yet the other players at the table refuse to let him leave. In fact, they keep handing him more chips. This is not a game of charity, it is a game of survival. The rest of the world has performed what economists call a double bet on American risk. They have not just lent the United States money, they have tethered their entire future to the hope that the American machine never stops humming. As of 2025, foreign entities own nearly 30% of all US treasuries. Japan sits on a mountain of over $1 trillion in American debt, followed by China and the United Kingdom. These are not just investments, they are handcuffs. But the trap goes much deeper than government bonds. The rest of the world is also a massive shareholder in the American dream. Foreign investors currently hold a net foreign asset position of negative $19.77 trillion. They own roughly 25% of the entire US public stock market, and up to 40% if you include private equity and direct investment. Every time the market ticks up, a sovereign wealth fund breathes a sigh of relief. They are desperate for America to succeed because they have nowhere else to put their capital that offers the same depth. The true horror of this system is the collateral chain. In the global financial plumbing, US Treasuries are the global safe asset. They are the foundation upon which the entire world's credit is built, used as collateral for trillions in trades and satisfying the safety requirements for every major bank on the planet. This leads us to a terrifying ethical reversal. If the United States were to default, or if the market simply lost faith in that safe collateral, the global credit markets would not just slow down, they would freeze instantly. We have reached a point where the rest of the world has a stronger economic incentive to save the US economy than the US government does. They are forced to provide a floor for American asset prices, because the alternative is a total global blackout. If the United States collapses, the ones who lose the most are not the Americans. The world does not support the dollar because they love it. They support it because they are trapped by it. Imagine the year 1944. A group of men gathered at Bretton Woods to decide who would own the future. They emerged with a system that crowned the US dollar as the world's reference currency, granting Washington an exorbitant privilege. This privilege allows the United States to run massive permanent deficits without going bankrupt. But every cheat code has a bug called the Triffin dilemma. To keep the global economy moving, the US must flood the world with dollars, which requires running deep trade deficits. Over time, these very deficits make the world wonder if the pieces of paper they are holding are actually worth anything at all. America has effectively perfected the most profitable export in human history: inflation. The United States prints green pieces of paper at almost zero cost, and in exchange, the rest of the world sends over actual, tangible goods. We export the debt and they export the sweat and resources. This is not a system built on superior management. It is a system built on the fact that everyone else is already too deep in the pool to climb out. The too big to fail label now applies to the entire American ledger. We are all participants in a global game of chicken where every player is strapped into the same car, hurtling toward a cliff. But in 2022, the rules of the game changed. When the US froze $300 billion of Russian reserves, it sent a shockwave through every non-Western capital. Washington effectively announced that sovereign assets are only sacred as long as you stay on their good side. By weaponizing the global payment system, the US proved that your national savings are merely a line of code that can be deleted at will. The privilege is visibly fading. A 2025 survey revealed that 76% of central bank reserve managers now view the risk of US sanctions as a significant factor in how they allocate their wealth. They are no longer just looking for a return on investment. They are looking for an exit strategy. History is not a collection of random accidents. It is a series of predictable echoes. You will see a four-stage pattern of financial destruction that has remained unchanged for centuries. It begins with the foundation, a period of stability that builds trust. Then comes overextension, where credit expands far beyond the physical assets that support it. The third stage is the cracks. This is the phase where a sudden shock reveals that the foundation has been hollowed out by debt. Finally, there is the collapse, a rapid contagion where liquidity vanishes. We have seen this movie before. In ancient Rome, Emperor Tiberius was forced to intervene with a massive bailout of 100 million sesterces to stop a total market freeze. Today, the modern global economy has entered its own stage of the cracks. In 2023, the collapse of Silicon Valley Bank was the first major signal. But that was just the appetizer. We are now looking at a $3 trillion crisis in commercial real estate and the volatile reversal of the yen-carry trade. These are not isolated incidents. They are the tectonic plates of the global debt trap beginning to grind against each other. Systems do not explode because of a single black swan event. They fail because the foundation has been eaten away by decades of compounding debt. We are beyond the era of easy fixes. The Federal Reserve is now trapped in a mathematical prison. If they lower rates to save the economy, inflation destroys the dollar. If they keep rates high to save the currency, the debt becomes a black hole. As the 2027 tipping point approaches, central banks are no longer debating whether the dollar will survive. They are aggressively buying gold and building alternative payment corridors to prepare for what replaces it. History teaches us that power is not held by the one with the most gold, but by the one who controls the debt of others. But when that debt becomes unpayable, the master becomes the slave to their own bankruptcy. Rome did not fall in a single afternoon. It faded, then it fractured, and finally it vanished. We are currently watching the fading. If you recognize these patterns while the world sees only chaos, you are no longer a victim, you are a witness. If you value this cold analysis over mainstream noise, type 1 in the comments. Join us at Financial Money History as we decode the next chapter of this unfolding collapse.